Okay, part three. I mean, it isn't, it's very normal, especially when you're in, if you like, in manufacturing or in construction, to continue to add value to an asset by expanding the warehouse, by expanding, if you like, the factory. This is very normal. Now, of course, I guess I also think about it as well as your own home. If you were putting in a conservatory, if you like, you can see that immediately increases the value of your home. So the question here is that as long as we are dealing with the enhancement of the economic benefits, so for example, if that can now create more space to bring in more rent, or it makes a machine go faster, so you're doing something that can actually enhance, if you like, the economic benefit provided by the asset, then we can capitalize it. Only then should we be able to capitalize it. So typically you have very much this idea of an overhaul, if you like, after an inspection, and this should be capitalized and of course depreciated over time until the next overhaul. So in effect, we're talking here about complex assets where there are different components to the asset, and of course you have to sort of treat it that way. That's the best way to really do it. I mean, like I gave the example of a plane, for example. So what do we have here? So it says we have a piece of machinery that has an annual service costing £10,000. So this is an annual service cost. This is revenue expenditure. It tells us it's about servicing, maintaining, isn't it? During the most recent service, it was decided to replace part of the engineering, so it worked faster. That's exact. So the key point here is this replacement cost is a capital cost. So where we are debiting revenue and crediting bank with a 10K, here we are debiting the asset and then crediting bank, because here we can capitalize the 20,000 very clearly. It's a capital cost, and they tell us here. Yes, isn't it? There, because it's able to bring in future economic benefit, if you like. So that's the first thing and that's subsequent expenditure. Really, nothing really over it there. Depreciation has not changed. Depreciation is an accrual thing. It's really from our accruals concept. We must recognize. Basically, we cannot just have income. We must match it with the relevant costs. So all income must have an associated relevant cost associated to it. And really, depreciation is really the way we manage this. And IAS, or accounting standards, want us to require that expression of cost against related income. So of course, calculating it, we must look at the cost itself for the period. So if that thing can be sold and over really the period, right, that you're using it. So for example, you have 10 million and you intend to sell something later on for the asset at the end of its life for $1 million, you will only enjoy the benefit of 9 million over the life that you intend on holding it. I don't know, whatever that is, and that's how you should work that out. Yes, and typically we must charge depreciation from immediately the asset is brought into use. Yeah, I mean, typically, if it is brought into use earlier, if they need to be trained to use it, yeah, that's fine. But of course, even though the asset is idle, this is very much part of the obsolescence of an asset, so depreciation must continue. Depreciation must continue, because really, depreciation is very much, I think, subjective to the market environment. Of course, it's not something you control, right? If your asset is not being used, or if there are new models coming out, depreciation really is recognizing why not an increased fall in value even versus the income it's bringing in. Okay, great. So ultimately, we want something fair. We want a method that is fair. The depreciation method used should reflect as fairly as possible the pattern in which the asset's economic benefits are consumed by the entity. And again, with machinery, the reducing balance method seems to work well, because most machines are used quite aggressively at the beginning of their lives, and typically after a couple of years the organization is looking to exchange or sell off that machine. So you're rarely holding that asset for the length of its life, which kind of makes sense with machine hours as well, because most of the machine is new, and a lot of the machine hours will be generated very earlier on in the career, and then less and then less. So you can see that there is a graded sort of element here of use. Um, you can. I mean, we will come IAS 8. I'm sure we will come to see it soon. But a change in method is really what's referred to as an accounting estimate, and that makes sense. Really, we're looking perspective. We're looking ahead, because we thought we were going to use the asset in this way for this in this capacity. When we've changed the way we're going to use the asset, or we've changed the length of time we're going to use the asset for. So you can just make new judgments, because the truth is, even accumulated depreciation is a provision for depreciation. So just adopt or adapt the provision to now align, to make it a bit more relevant. But of course, we're changing method because the new method will give a fair representation of the results and of the financial position. Like I say, this is not accounting policy. It is a change in accounting estimate. And then we just recognize the amount over the period remaining. So typically, like I think I've highlighted before, if an asset is classed as a complex asset, it has several parts. I gave the example of an airplane. So some parts of the airplane will last for 20 years, and some will last for 5 years, and whatever it is, we want to make sure we're dealing with the parts separately, if you like. We're dealing with the parts separately. Okay. Again, like I said here, each separate part of the depreciation should be depreciated over its useful life. We have an example here. I mean, this is nothing. I'm just highlighting what you know already. We have an asset here that costs 100,000. That's the asset. Expected life of 10 years. The user intends to use it for 6 years, at which the residual value is 40,000. So like I said here, you intend to use it. Here we are, 100,000. You will sell it off at 40. So you intend to use 60,000 of its life, if you like, spread over 6 years. That's your intention, and that's what we should therefore recognize. Right. So this is what they were talking about earlier on. This question of carrying out a review. You bought this thing for 100,000. Your intention is straight line 20,000. So I'll just draw a little timeline here. So there you have there 100,000, and then the intention is that you use it over a 5-year period. 1, 2, 3, 4, 5, and that's brilliant. Straight line depreciation of 20,000. So it says here the annual review of the asset is undertaken, and the remaining life as at the 1st of January 2007. So here we have 31st of December 05, 31st of December 06. Technically, this is the 1st of January 07. So after 2 years of a fall of 20,000, we have an asset that's valued at 60,000, right? That's kind of where you can see where I'm going with that. And it says you review it here, and you realize that actually the remaining useful life is going to now be 8 years. So we start from here, and we now look 8 years down the line. They're not giving us a residual amount. Oops, sorry. Oh, right. Right. Okay. I thought I had the second part to this. So really, it says what is the depreciation charge for the year ending 31st of December? Well, that's 60,000 divided by 8, right? 60, because it's going to now be the new depreciation falling over the period of time. So that's 60,000 divided by 60,000 divided by 8. 60,000 divided by 8, which is 7,500. So now we have a new depreciation charge going through the accounts for the next 8 years. And let's quickly look at the next one before we take a break. This is what we're talking about in parts. It's really important to always separate your assets into parts, if you can. It says here, entity purchases an aircraft that has an expected useful life of 20 years, no residual value. Aircraft requires a substantial overhaul at the end of 5, 10, and 15 years. Aircraft costs 25, and 5 million of this figure is estimated to be attributable to the economic benefits that are restored by the overhauls. In year 6, the cost of the overhaul is estimated to be 6. So I'm going to separate this asset into 2 parts almost. I have my sort of standard asset of 20 million, and there's a bit here that's related to the overhauls in particular, if you like. And really, what I'm doing is, again, you're always trying to see how I can separate out clearly what the asset is and its parts, if you like. And Yes, so again, like I say here, it says that it's going to be 20 years, so that's the normal asset, if you like, 1 million. And what we have here, as you can see here, is that every 5 years, we will have to carry out some kind of overhaul here. It will come to the end of its life every 5 years, and so 1 million here, and then we will need to restore it again. So really, depreciation every year for the next 5 years is 2 million, which is made up of the 1 and 1, 2 million. But then once that first overhaul is complete at the end of year 5, then I overhaul at the beginning of year 6, if you like, and then for 6 million. So it's almost as though I have one asset now that's worth 15 million, and I've done my overhaul, and my overhaul is 6 million. Remember, I'm capitalizing the cost of my overhaul. All the money I spend overhauling is actually, think of it as buying a new asset. And that overhaul will now last again 5 years. Which is why that's 1.2, but the asset itself continues to fall, of course, by 1 million every single year. We calculated that from the beginning. So my depreciation charge, if you like, is now in total from year 6 to year 10, 2.2 million. Cool, great stuff. So the key point there is, again, well, hopefully as we do exam questions, kit questions, you will see more of these, but it's trying to separate out the asset and its parts, and then looking carefully. You can get another question that could tell you that this asset has different lives, or different residual values. So you're just dealing with those costs separately and then adding their actual depreciation on each of them through the income statement. Okay, great stuff. See you in part 4.